So I'm going to be walking you all home for the rest of the session, which should be about 15 to 20 minutes, going over another concept for estate planning that's going to be whenever you've done well enough for yourself and you realize that you will not be needing all of the money and the investments that you've accumulated over your lifetime, that money that you are thinking of leaving to family and beneficiaries as an inheritance, this is the topic that I'll be covering. So traditionally, the way that most individuals will think to leave money to the next generation in terms of an inheritance, they will say, I've accumulated this amount of money, and in the rest of my lifetime, I'm going to use up and spend whatever I need, and whatever is left over, I'm going to leave that on the table for my kids and beneficiaries in terms of an inheritance. This should be a fairly common storyline because it's the one that we tend to hear the most. However, if we are thinking about estate planning, we'll also end up thinking, whether we want to or not, about taxes. We'll also sometimes think about control because there are different ways to plan for estate, some of which we're going to be covering today, as well as the advantages and the disadvantages of each. So in a scenario that someone is looking to leave money to family members, there's typically going to be a tax consideration, as I mentioned, so that we can call as short-term tax. We can also have long-term tax. We could also have as an obstacle control or access. And we could also talk about cost. So if this individual is looking to accumulate their investments and eventually whatever is left, pass it on to the next generation, those investments will be generating some type of taxable income, interest, dividends, etc. So on a short-term year-over-year basis, they're going to end up having taxes that they will have to pay on these investments until eventually they pass it on to the next generation. Additionally, these investments that the parent or the individual will be holding on to in their lifetime over the years will increase in value, and eventually whenever they pass, it's going to be considered a sell. So capital gains will be triggered, taxes will be triggered, and if you're tuning in from Ontario, you'll also have probate, which is another 1.5% approximately, that will be tacked onto that. So we can call all of that long-term taxes. So in order to be able to find solutions to circumvent, to be able to minimize these taxes, there's a few different solutions. Now, traditionally, if an insurance representative was looking to help with life insurance to be able to handle these two aspects, they would say, Mr. and Mrs. Smith, we project that based on your estate plan, you're going to have $500,000 worth of taxes whenever you pass away in 30 years. So let's go ahead and let's purchase some life insurance on your life to cover those taxes whenever you pass away. This would be, to a certain extent, an interesting strategy. However, since the investment owner, Mr. and Mrs. Smith, are still holding on to those investments in their name, they're still accumulating the short-term and the long-term tax. However, that insurance strategy of purchasing life insurance on their own lives will have a relatively high cost due to their age. So this won't always be the best way. Sometimes I'll hear a scenario that parents will say, you know what, Abraham, I have a good relationship with my kids, so I'm just going to go ahead and give them this money ahead of time. And if ever I need it, I'm sure my kids are good. They'll be able to pass that money back to me. Now, if they were to do so, the short-term tax that the parent had is only going to be transferred to the kids. So the kids now holding on to this money, it's still going to be generating some interest, dividends, etc. So the kids are going to end up having the short-term tax problem that the parents were looking to eliminate for themselves. So it doesn't really get the job done. Admittedly, the long-term tax issue of the parents passing away will have zero consideration in terms of capital gains and tax. So that's a positive. That solution would be good to take care of the long-term tax. However, the control or the access to that money would be somewhat questionable. Because if your kids tend to take that, let's say, early inheritance and put it into real estate, it might be difficult for them to liquidate that property to be able to give you back some money if you end up needing it at some point later in life. The access and the control is lost. The cost also ends up being somewhat irrelevant. Whatever you would have been paying on your investments, let's say the MERs or the fees, would simply be transferred over to the kids. But the big issue here is that the control or the access has been given up. In other circumstances, individuals will look to be able to set up a trust without going into the details. Suffice it to say that it is costly as well as complex. So today we're going to be looking at another strategy using life insurance, which should be able to check off all or the majority in big, bold, the different obstacles that we would have. So let's take this instance that an individual says, I'm looking to leave a certain amount of money to my kids. However, I want to minimize the short long-term taxes, as well as have access to that money, maintain control, while limiting the cost of some type of, let's say, expensive strategy, trust, etc. So the most important element here is building a financial plan or a retirement estate plan so that we can identify what is the amount of money that we're fairly confident you will not be needing. And then what we can do is we can purchase a life insurance, not on the parent's life, but on the kid's life. So in this case, I'll just say father and son to keep it simple. So the father will be able to purchase a life insurance on his son's life and will be able to put investments within that life insurance on an annual basis. And by doing that, his personal investments of the father are decreasing because the value of the investment inside of the life insurance is increasing by that same dollar amount, or let's say comparable or equal amount on an annual basis. So the short-term tax is gradually decreasing until it gets down to zero because the investments held inside of the life insurance are not taxable on a year-over-year basis. So you won't be receiving any type of interest income, dividend income, no capital gains if there's changes within the investment that's held inside of the life insurance. So as we're putting monies, we're depositing money into the life insurance policy that's on the life of the son, we're able to definitely take care of the short-term tax consideration, not only for the father, but for the son as well. Neither of them will have this tax issue. So the next one that we need to tackle is going to be the long-term taxes. So here, whenever the father eventually passes away, because he's not holding on to the investment, it's on the son's life, there's no tax consideration whenever the father passes away because the life insurance is still intact. The life insurance is not paying out when the father passes away. The life insurance, it's on the son's life, so that will still continue to exist. So this is yet another way that we can handle taxes. But in this scenario, it's going to be the long-term taxes, no capital gains tax, no probate, again, for the listeners in Ontario, whenever the father passes away. So this is another topic that we can cross off in terms of a checkbox. For control and access, this is kind of a big one because even though we always want to think of the future and help out kids and family members, there's always this thought in the back of our mind that will say, well, what if I need this money? What if something happens, there's a big curveball, there's a health issue, and I've put all of my money inside of this life insurance for my kids, and I'm glad I did it for them, but now I need it. So the nice thing is that while you have the investments inside of the life insurance policy, you're still the owner. You own the investments inside of the life insurance policy. So if you needed to, you can make use of the investments. You can either withdraw, you can borrow against it, you can essentially use the investments within the life insurance policy for your own purpose. Obviously, if you do that, there would be less that would end up going, in this case, to the son. But if they were traditional investments and you end up using them, you end up in a similar scenario that there's less that's going to the kids. But suffice it to say that in this scenario, at least you're holding on to the control. So the control and the access to that money is maintained. You're in charge. It's also important to say that should you have relationships that deteriorate, it's not very common, it's unfortunate, but it does happen. Since you're the owner of that investment and the insurance policy, you can change the beneficiary. You can eventually leave that to your grandchild. You can leave it to someone else. You can make the beneficiary someone else. So you have full control. However, typically what we end up seeing in this type of scenario is that the father at some point will decide to give over the ownership of that life insurance to his son, whether in his own lifetime, if he feels confident that he doesn't need it, or at the moment that he passes away, the son will by default be the new owner of that life insurance policy on his own life, which includes the investments within. And the key piece to all of this will be the cost. So as you would imagine, a life insurance policy on a, let's say, retired or close to retirement individual will obviously be more expensive than on the child or the beneficiary, the younger relative of that individual. So the cost ends up being considerably lower. So these are the important elements to be aware of. Some important considerations will also be not just for the father, but for the son in this case. So what's in it for him? What's in it for him is that he will eventually at some point receive a life insurance, which is on his own life. So similarly to the way that Lakshmi explained, if they're looking to purchase a property and they have a mortgage, there's a spouse, there's kids, at least that son, whenever he is receiving that life insurance policy, at least he'll have the coverage needed to be able to take care of the mortgage or his family members should something happen to him. He can otherwise say, you know what, I'm going to use some of the money within the policy to be able to put it as a down payment towards a home. And they can use the remaining coverage to cover the mortgage, or they can quite simply get a short term, the term coverage that Lakshmi was referring to earlier, to cover that mortgage, since it'll be temporary, right? Mortgages are for, let's say, 20, 25 years on average, we hope. And the life insurance that's holding on to the investment can be maintained for his legacy, his own, let's say, inheritance to his own kids. And if the son were to name his son as the beneficiary, then essentially the father in the original scenario would have been able to defer taxes by 2 generations, potentially 3 generations, depending on what's the gap between the age gap between having kids. So if you think of it in the traditional investment way of doing things, the investment will accumulate. Then because of the capital gains, the appreciation that we've had, when the person passes away, some of it will be lost due to taxes and passed on to the son. The son will invest and let that money grow. When he passes away, some tax will have to be paid as it's moved on to the next generation. So each time it's increasing, but having a drop, increasing, but having a drop. Whereas with this scenario, the investment will be able to grow and no taxes need to be realized for multiple generations. And as I'm mentioning that the investments will grow, typically the investment within the life insurance policy will grow at an approximate rate that's going to be close to 6%. So it should be a number that you've heard myself and Lakshmi say a number of times. I can draw the whole pie chart, but I think you guys understand where the 6% comes from. So this is going to be, for the most part, how it will work and where the benefits are both to the father, the one that's leaving the insurance or the inheritance rather to his son, as well as the benefits to the son to be able to receive this, and obviously the short-term tax, long-term tax. So this is actually quite a big one because I'm sure as you've all pretty much prepared your tax returns, every year there's always a little bit of interest and dividends that's being received. We don't really realize it, but it does eat away at the capital or the net worth. We try to always tighten that faucet for you all in terms of the investments, but there's always a little bit of a drip that does occur. Not always, but often. So this is an important one to consider, the long-term taxes, having the control as well as the access. Another point before moving on to that corporation topic, which is a similar line of thinking, is that as you are holding on to the investment within the life insurance, I mentioned that the average or typical growth rate is approximately 6%. Now, here's an interesting one for you. The growth rate can be positive, but it can never be negative. Let me say that again. The growth rate can be positive, so when markets are up, that investment will also be up. However, when markets are down, you will see the value of that investment staying flat, but it will not go down. So this can also be a different way to diversify your assets and your net worth. The way that that would happen is if you're holding on to real estate, which is a great investment. You can also have some investments in the stock market, stocks, bonds, mutual funds, ETFs, etc., which is a different type of investment from real estate. And then you can have the investment, which is inside of the life insurance policy, which again will increase, but will not decrease. So it'll be able to give you a different feeling for your assets relative to investments that are purely held in the market. This is usually kind of an important one when going over with clients. So those are the main points to be able to diversify the assets, the growth that we talked about, the benefit for the kids that we've talked about, as well as for the individual that's looking to be able to pass it off. Another consideration is that if the individual is disabled, they can actually withdraw some of that money up from the life insurance policy, the investment component, without any type of tax consideration. So that's an important one as well for those that are thinking to get disability insurance, but haven't necessarily jumped in. So this can be another way to be able to fit into that. And let me see my notes here. One final one. So this is kind of an interesting one that I find as well. Oftentimes parents and clients will say, you know what, Abraham, I'd like to leave some money to my kids, but I also want to be able to spend for myself. So I find that whenever there's a certain amount of money that's been carved out for life insurance, the parents know that there is already an amount that is dedicated to go to the kids. So whatever remaining money or investments that they have for themselves, they can spend it guilt-free, knowing that there is an amount that's already pre-reserved for the kids. And the deposits that I'm mentioning or paying for the life insurance, it doesn't have to be until the lifetime of the parent, the father in that scenario, but it can be paid over 20 years. And if you find that's long, it can be paid and deposited into over 10 years, or even shorter than that. We can look at an 8-year window where if you're somewhere in your 50s or 60s and you're thinking of applying the strategy in the remaining working years, at least we know that over the next 8 or 10 years, with the income that's coming in from work, we can definitely deposit the money inside of the life insurance strategy discussed with predictable cash flow. So that's going to be for the personal side. I'm just going to catch my breath and have a sip of water, and then I'll get into the corporate version of this. So for the corporate version, it's actually quite similar for those of you that have incorporated entities, corporations. You know that whenever you're going to be taking money out of the corporation, whether it's a salary, dividend, you name it, taxes will again be popping up. So in this scenario, the corporation on a year-over-year basis will also have short-term taxes. So if the corporation is holding on to some retained earnings, some investments inside of the corporation, those investments again are giving some interest and dividends. So that's the short-term tax, which would still apply to the corporation. We'll also have the long-term tax, and this can be delicate whenever you have a corporation, because the money is going to get taxed to the corporation. And then as that money is coming out of the corporation, it will again be taxed. So the long-term tax is a consideration as well. Again, control or access. So if we're looking to make use of the money for business use, for different projects, purchasing inventory, software, property, etc., we want to make sure that that's there, and all the while making sure that we're not ignoring the cost. So what the business owner will be able to do, or the corporation rather, the corporation can purchase life insurance on the business owner's life. And as the corporation does so, they're able to gradually deplete the investments, the retained earnings within the corporation by putting them inside of the life insurance. So over the course of 8 or 10 years or 20 years, as you wish, we can gradually and completely eliminate the short-term taxes, because if the company is no longer holding on to investments, it's not going to be spinning off any type of taxable income. So that faucet is completely tightened, no drips, no drops, nothing. And again, the investment within the life insurance, zero taxes on an annual basis on account of distribution. Long term, so this is actually one that I love. Your accountant and you may be familiar with something called a CDA. So that's your capital dividend account. It's not a real account, it's just a notional account that your accountant keeps track of. And whenever a life insurance is paid, once the business owner passes away, that life insurance will go to the company and life insurance will get credited to the CDA. The CDA, all what it means is that whatever credit you have in the CDA, you can take out of the company tax-free or with extremely negligible taxes. So as the corporation is purchasing life insurance on the business owner passes away, the life insurance gets paid to the corporation, and that gets credited to the CDA, giving the corporation the ability to withdraw that, let's say, $1 million worth of life insurance out of the corporation, and it goes to the beneficiaries, spouse, relative, etc., on a tax-free or very, very nearly tax-free basis. So this is a massive one. And if you have a corporation in the audience, you can imagine the tax benefit to that. But obviously we can run the numbers so that you can see for yourself. Control and access again comes into the picture. So this is going to be in a scenario that you might say, the business owner might say, well, you know what, I don't want to put all of my retained earnings inside of the corporation, because what if I want to buy another property? What if I need to purchase software, inventory, you name it? But again, same like in the personal scenario that we saw a couple minutes ago, the corporation would have the ability to withdraw out of the life insurance if needed, or they can set up a line of credit against that life insurance, which can make that interest on the line of credit tax deductible. So to be confirmed with your accountant if you'd like. But essentially you can have access to that money within the life insurance that the business can use for different purposes. So the control and the access definitely there, maintained. The cost in this case can also be reasonable, not as reasonable, I have to admit, as the one based on the child's life. But again, if we are looking to apply the strategy, it has to be sensible. So we could always have a look at the numbers to see if it's justifiable or not. For the tax consideration, particularly for the long-term tax, usually it does still make sense. It's also important to remember for individuals that for almost any type of life insurance that we've been talking about so far, you can take as an assumption that it's tax-free. So whether it's going to be the term insurance, et cetera, that Lakshmi had talked about, or the one that I had mentioned previously for the personal, for the corporation, depending on the numbers, it might be zero or it might be a very, very insignificant or low number, which we can definitely get into. So that's going to be the consideration for the corporation. There's also different scenarios which we can get into, which are maybe a little bit more delicate or tricky. But as one final example or concept, if someone says, well, you know what, Abraham, I have $500,000 inside of the corporation, and I'd really love to spend some of that money now instead of waiting for me to pass away so that my beneficiaries will get that money tax-free. There are also different ways for that individual to be able to spend some money, let's say 500,000 if they wish, personally, and upon their passing for whatever it is that they've made use of. So not a recommendation to borrow, but just as an example, if they've used $1,000 or $100,000 from their personal line of credit for personal use, and they'll be able to have the life insurance from the corporation payout to the beneficiary, which would again be able to close off the line of credit that they've made use of. Just a little bit of sensitivity there, but because depending on who the beneficiaries are, you want to make sure that that is in fact going to get done. So that's the topic, really making sure that we cover all of the different points. Whenever we are looking at these numbers, we really need to build a financial plan to be able to see, do the numbers make sense? Is the fee or the cost of life insurance suitable? And does it make sense for you? So I hope that it was easy to follow and easy to understand.